Capital Markets, and Kathryn joins us now with her take on what's been happening in the stock market. Nice to have you back with us.
Thank you, John.
Putting in context that big sell-off that we saw yesterday, what's your opinion of what's happening in the markets right now?
Well, profit taking began, John, the day before as we saw outflows from major growth ETFs. So I would say that it was a culmination of profit taking in the high flying sector, which is, of course, technology, with the five most common names thrown around: Facebook, Google, Apple, Microsoft, Amazon, being the principal reason for the market's ascent over the past, let's call it 3 years. So from 2017 to 2020, it's been those names that have taken the market higher. So I believe it was more attributable to profit taking than to renewed virus scares, which I think a lot of the media pointed to. And then it just kind of culminated into let's get our gains before this melts down. My view is that this was nothing more than a dip, and for sure and definitively a buying opportunity, John. And I say that not just because it's something that I think is temporary in nature, but because there's so much cash on the sidelines, just in breathless anticipation of this sort of comfortable 3 to 4% dip, that my contention has been that money would flow in looking for opportunities.
Kathryn, if you do see this as a buying opportunity, what are the kind of opportunities you see? What are you going to be looking at?
I really liked tech dropping off 7%. I mean, you saw NVIDIA drop 10%. You saw Facebook and Microsoft and all of the big names that really haven't lost their place in the current new normal, which is really what we're doing here. I don't have to go to a studio to be on the program with you. I can do it from the comfort of my home. Same thing with our jobs. So this is a dynamic that's shifting, I think, definitively towards technology, and that's not going away anytime soon. So, hey, I say, when tech sells off to this magnitude, buy it, because it's more than 25% of the S&P 500 here in the United States. So if the S&P drops off, it's because of tech. So if you buy the S&P, you're buying tech regardless. I say buy tech, I say buy industrials. And I would also encourage people to look at banks because they are very undervalued at this point.
The other interesting dynamic, on a typical day, if there's a huge stock market sell-off, you might see investors gravitate towards gold, but gold's kind of become this complicated trade in the sense that it has been very popular. I mean, even here in Canada, I don't have to tell our regular viewers that the percentage drivers of the TSX in 2020 are tech, which is a smaller index here, but also the materials index, which is dominated by gold stocks. And so how do you view gold when we're talking about the subject of buying opportunities?
It's a great point. Yesterday was risk off, and you did not see gold surge. You saw treasuries benefit, but you definitely didn't see what one would have otherwise expected, which would be gold to increase. So I think gold remains in a kind of a perfect storm. I like buying gold on dips, and the perfect storm being, look, we have negative real interest rates or low, depending on what country we're talking about. But in a general sense, interest rates are very, very low, which makes a non-yielding asset such as gold more attractive. You have expansive monetary and fiscal policy, which leads to inflation at some point, which is gold positive. Plus you have lingering geopolitical and health scares, electoral in my country. So you have a lot of positive factors for gold. And I wouldn't discard also, John, the idea that there could be a crisis with regard to fiat money at some point, just because we are really, really putting ourselves in an inflationary scenario at some point. So all of that, I think, is good for gold. I think it's an important part of anyone's diversified portfolio. It's a great hedge. So my recommendation to our clients has been buy gold on dips.
Kathryn, we mentioned off the top of the 9:30 market open that in Canadian trading today, you've got a bank in Laurentian Bank that was a top performer. We were talking earlier in the program with J.J. Kinahan of TD Ameritrade, and he said in the down day, the sell-off yesterday, not like people were doing a lot of buying of anything, but there was a little bit of nibbling on financials, some of the bank stocks. How do you feel about a sector like that?
I think banks are a great sector, John. They are one of the three sectors that have most dragged this upward momentum in the S&P 500. I think everyone knows that rates are going to stay low forever. So the lack of margin for banks is already baked into the prices. And the fact is that if we are in fact in an economic recovery, banks are only stand to benefit from that. So I think that just valuation combined with fundamentals, for me, I think banks are probably going to be the top performing sector going forward, because we've seen such a tremendous run in tech and other growth stocks. So I like banks. I also like industrials. So I'll also revert to that sector. And I think those are two sectors that have, as I mentioned before, John, pulled up the rear. So if you do expect this kind of broadening out of market moves higher, then you want to be in the more underperforming sectors. And I do have to mention one other thing, John, which is we can't forget the potent impact of the Federal Reserve's asset purchase program. So yesterday we had Charles Evans, who's an FOMC member, saying in the middle of the drawdown in the equity markets, another QE program isn't out of the works. So the fact is that the Fed is going to back the markets. And if we get a meltdown, the Fed will move in to buy.
Well, you cannot forget about the Fed. That's certainly one of the messages of this market in 2020 or any year. Hey, Kathryn, thanks a lot. Kathryn Rooney Vera.